Let's talk about gold in 2026, because I know what you're seeing online. One person says, gold is going to the moon, another person says, it's a bubble, so you're probably thinking, okay, what's actually true? In this video, I'll break gold down in a simple way. What moves it, why it can jump, why it can drop, and what the realistic paths for gold look like in 2026. No hype, just clarity. First, what is gold in the market? Gold is not a company. It doesn't sell products. It doesn't pay dividends. So why do people buy it? Think of gold like financial insurance, not the kind that makes you rich overnight, but the kind people run to when they're nervous. And people buy gold for three simple reasons. Number one, protection. When people fear crisis, war, inflation, or political chaos, gold often looks attractive. Number two, diversification. Some investors add gold because it doesn't always move the same way as stocks. And number three, currency protection. If people lose trust in money, gold becomes a store of value for a lot of people. So gold is less like a growth investment and more like a hedge. Now, what actually moves the price? There are three big drivers you should know. The first one is the US dollar. Gold is priced in dollars, so here's the simple rule. When the dollar gets stronger, gold often gets weaker. When the dollar gets weaker, gold often gets stronger. Why? Because for people outside the US, a stronger dollar makes gold more expensive in their currency, so demand can cool down. Just remember this. Dollar up. Gold pressured. Dollar down. Gold supported. The second driver is interest rates. And the thing that confuses everyone. Real rates. Here's the easiest way to understand it. Gold does not pay interest. So if you can earn solid interest somewhere else, like short-term government bonds, some people think, why hold gold if I can get paid to hold cash-like assets? That's called opportunity cost. Now, real rates. Real rate is basically interest rate minus inflation. So if a bond pays 5% and inflation is 3%, your real return is around 2%. And gold tends to like it when real rates are falling. Gold tends to struggle when real rates are high and rising. So the simple memory is, real rates down, gold usually likes it. Real rates up, gold usually hates it. The third driver is fear, uncertainty, bad headlines. When investors get scared, trade conflict, tariffs, geopolitics, recession fears, money often runs towards safe assets. And gold is one of the oldest safe havens in history. So when headlines get messy, gold can spike. But here's something you really need to know. Gold moves in waves. It goes up on fear, then it pulls back because people take profits. Then it can go up again if the fear continues. So, if you see gold drop after a strong run, that doesn't automatically mean the story is over. Now, here's the part most beginners miss. It's not only regular investors buying gold. Central banks, the institutions behind national currencies, have been buying gold heavily in recent years. Why would they do that? Because gold is a reserve asset. That doesn't depend on another country's currency. So when central banks buy, it can create a strong base of demand. That's why gold can stay supported, even when it pulls back. Now let's talk predictions. You'll see a lot of numbers online. Ignore the hype. The smart way to think about gold is in scenarios. Because forecasts aren't promises. They're basically saying, if this happens, gold could do this. If that happens, gold could do that. So here are 4 realistic scenarios for gold in 2026. Scenario 1. The economy slows, but doesn't crash. Inflation cools slowly, and central banks cut rates gradually. In that case, gold can stay supported and grind higher over time, but with pullbacks, not a straight line. Scenario 2. A big risk shock. Trade conflict gets worse, geopolitics escalates, or recession fears spike. This is the gold jumps fast scenario, because when fear hits, people rush into safety. Scenario 3. Inflation stays sticky, rates stay high longer, real yields stay elevated, and the dollar stays strong, that's a headwind for gold. In that case, gold can go sideways, or correct more sharply. Scenario 4. Markets calm down. Stocks rally strongly. Fear drops. Money rotates back into risk assets, and gold can underperform. So how do you follow gold like a pro, without overcomplicating it? Watch 3 things: real rates, the US dollar, and risk headlines. If real yields fall, gold often gets support. If the dollar strengthens, gold can get pressured. If fear rises, gold can catch a bid. And remember, even in a bullish gold year, pullbacks are normal. Gold is not a straight line. If you have any questions, drop them in the comments. I'll reply to all of them. And if you enjoyed this video, please hit the like button. It really helps the channel. Subscribe, and turn on the bell so you don't miss any videos. See you in the next one, and safe invest.